Welcome everyone to the Collaborative Finance Enabling Sustainable Growth for SMEs panel. My name is Charles Osborne from TXF. I'm very pleased to be joined by Tom James, CEO and CIO from TradeFlow Capital Management, and Ozan Ozturk, Managing Director at Agrizan Commodities DMCC. A solution for mid-size and SME traders, I think we can all agree, is becoming increasingly important, particularly in the current climate. A report from ADB stated that rejections in the mid-size and SME space were at 74% for 2018 and 2019. And that was actually an increase of 26% from 2013 to 2019. So this panel will look at collaborative finance as a potential solution. Perhaps to get us started, Tom, perhaps you could give us a quick overview of collaborative or hybrid financing and the benefits involved for all.
Yeah, certainly. I mean, it's a new thing. I mean, we've now seen trade finance funds, so non-bank lenders, becoming more and more active. Many more of them being set up in recent years. And so the idea that fundamentally is how you can sort of blend your bank lending with the non-bank lending, or in our case, as we don't lend money, sort of the looking at how as an enabler of trade using our balance sheet, we're able to sort of plug in with banks and other trade finance funds who are lending and transform the risk that they're taking, because that seems to have been one of the biggest headaches and why we set up TradeFlow Capital was actually that banks want to lend, but sometimes they don't have enough data or information or track record of particularly an SME size sort of company such that they can actually lend profitably to them.
Great, thank you very much. I mean, you know, that's great to hear kind of an overview of collaborative finance, but if we may take a little bit of a step back and kind of look at the challenges that SMEs are facing. You know, in the current climate, we've got banks retreating. There's a kind of a flight to quality mentality that's been going on for a couple of years, even pre-pandemic. You know, what are the issues that are currently facing SMEs? Ozan, perhaps you can kind of shine some light on that.
Hi to everyone. As you mentioned, you know, the issues are not only starting after COVID. If we need to go back a little bit, you know, to 2000, let's say 16, 17 onward, because we first of all experienced that, you know, the pioneer trade finance banks are exiting from the SMEs in 2017-18 period. Of course, there were a lot of reasons behind it, you know, just compliance stories, KYC stories, and their desire to do more corporate lending to the big accounts rather than dealing with, you know, multiple SME accounts. But of course, starting with the COVID period, and especially what has been happening in the trade finance world, just let's say the frauds or the bankruptcies or the bad debts, those stories has strengthened this period, and we have seen more banks exiting out of the market. This is first of all the first thing we have to outline. And let's say, you know, 2020 February onward, in the last 1 year, I think SMEs were the main category who were suffering at most, because for most of the banks to cut the accounts of the small sizes and exit from them was much more easier compared to the, you know, multi-$100 million lendings to the corporate accounts. And but on the other side, it was a little bit easier for the SMEs to adopt to these changes because the balance sheets were smaller compared to the big accounts. However, we are in an interesting period to see how the trend will continue. Will it continue in the similar way, or we will see some improvements? I think that should be the major topic of the discussion in this panel.
Yeah, absolutely. And it's interesting to look at the possible solutions and what might happen in the next couple of years. Absolutely. I mean, Tom, going back to you and, looking at, collaborative finance as a possible solution. In the current market, how necessary would you say it is for funds to kind of act as a first loss? And, can this actually improve bank appetite in the future?
I think so. I mean, obviously as a commercial exercise, but also an educational exercise, we went through last year a rating agency process, and for a senior debt program from our fund, and we were able to get a BBB+ rating. So that was at least a proof to us that using different layers of capital, so where we're buying and owning the cargo itself and monitoring the logistics, then we're also having the capital of our fund, someone coming in at a next sort of level or senior sort of lending level into our fund can get an investment grade sort of level, basically. So clearly there is the sort of transformative opportunity there where acting as a buffer, you can change the risk dynamics of the lending for the bank. And of course, we've already seen under Basel III that is really helps the banks out, because here we're dealing with small transactions, a lot of them, so a lot of costs there, KYC, AML headaches, which also can be, in fact, one of the major reasons that banks don't lend to particular transactions, because it's too small and it doesn't cover the costs of even their KYC, AML onboarding.
Great, thank you. One trend that I have kind of noticed with mid-size and smaller traders in particular, kind of going from bank financing to kind of non-bank lenders. Often they've come from a very historic low margin, and they've kind of gone, when they've gone out to kind of look at some of the non-bank lenders, they're getting quoted, not only are they facing difficulty accessing liquidity, but they're actually often getting quoted far higher margins than what they've previously been used to. And actually, in some cases, far higher than what is actually sustainable for their business model. So there is this real kind of price margin disparity that I think I've talked about on other panels. What solutions can possibly combat, and what sort of comments would you both have on this? Ozan, if we can just start with you, please.
Of course, now let's say alternative funders or trade finance funds or whatever you like to name it, as being the market participants, we know that they should be expensive than the banks. That's a reality. That is what we expect. But that cost has to be in a realistic way, because now I want to first of all share with you my experience after COVID period. We have been dealing with the trade finance funds since 2008. We have always accepted the reality, I mean the market players, their cost being a little bit higher than the bank. But in the last 1 year, what we observe in the market is we see more opportunistic approaches with higher than high level of costings being asked. Now, you can ask anything, you can charge anything, but the main question, does it fit the reality of the business? Does that cost has been melted in the business, and is it realistic? I think what the market needs is the equilibrium. Yes, there is lack of the trade finance banks. There will be alternative solutions, but these costs has to be realistic, not for today only. It needs to be in a longer time period. Otherwise, today, yes, there might be a desperate situation for any company who might need to use it. But what will happen after 1 year or 2 years? Will it be sustainable? Or that business model will continue with this high cost, which is not realistically being melted in the nature of the business itself. That's why I think these are the major questions to be answered, in my opinion, not from the part of the SME players, but I think this needs to be answered by the funders who are just investing in it. Because I just want to give another example to make a proper comparison. We have seen the upwarding trend of the alternative trade finance funds after 2008 crisis. We have seen extra liquidity in the market, and we have seen a lot of trade finance funds participating in the market. But at that time, their approach and the cost margins, or whatever you call, was more realistic. And that is why starting from 2009 till 2016-17, we have seen the increasing share of the trade finance funds in the industry. But today, I mean, in the last 1 year, what we see is, in my opinion, totally out of reality, and it is not a healthy environment creating solution for the time being.
I have to say, I fully agree, and for and it's a real shame, because I've seen some traders that have almost ceased activity for for at least a few months, if not a year. And I agree with you. I think in the sort of, it is rather unrealistic in some regards, and it's very much been in the last year since the pandemic that we've kind of seen this. And in some cases, I've some of the cases, the examples I've seen, I'm not really sure it's risk that's being priced here, but I think that's another discussion. Tom, if we could move this on to you, you mentioned before, about collaborative solutions and the lower lended rate that is involved in that. Perhaps you could elaborate a little bit on that.
Yeah, I mean, I guess people sort of describe it as sort of a blended rate there. So it's where you've got different people involved to fund a transaction. Obviously, our fund, TradeFlow Capital Funds, I mean, we've been able to, I think, be always at the lower end of trade finance funds in what we're charging, because we don't lend money, because we're actually investing in the cargo and owning that during shipment and storage. We could actually display a different risk sort of dynamic, switching from pure credit risk to operational risks, which are much easier to insure and manage, because they're in the real world. You can put people there on site. You can do various different things in the physical world to reduce risks. And so we didn't have to reprice, and we didn't during 2020 COVID situation. Our rates remained stable for everybody, all our counterparties that we were supporting. Whereas some people just had to stop lending altogether because they just couldn't price what was the real value of the credit risk in some countries and some situations. So I think that's also where, creating a sort of collaborative buffer, as it were, having sort of funds like ours, which can really keep track, thanks to technology these days and digitization, and having that data of the cargo and eyes on the cargoes and the commodities, and ownership of those commodities, we can actually really transform that risk. Now, banks would have been doing this 15, 20 years ago, but things have changed. A lot of the banks have unfortunately lost their in-house commodities expertise around trading, etc. So this is where people like us can come in and actually transform that risk and open up the liquidity so that the banks can lend in. So if the banks are lending in at investment grade rates, even if our rates are slightly higher because our cost of funding is higher as a fund, when you actually do that sort of 50-50 mix, let's say, you're bringing down the overall rates, but also unlocking more liquidity. And I think one of the biggest issues that we've seen for our SME customers has been where they've been borrowing money from a bank and it suddenly disappears, or they're borrowing money and suddenly the rate jumps up. A trader over a period of time, if slowly a rate changes, you can try to accommodate it and discuss it with your end buyers and customers. But if suddenly overnight your rate changes, that just kills a business.
No, absolutely. Yeah, couldn't agree more. And it's a real issue, and it's interesting to hear the sort of the collaborative blended rate that you mentioned as well. I think that's an interesting one for the audience. Going back onto something I mentioned in the opener, looking at some of the stats, which are pretty damning. That let's be honest. Looking at the kind of 74%, I think on the report that I was reading, mid-size SMEs kind of have their rejections. Have their applications rejected. A real increase, and I think what that emphasizes more than anything, because we're looking at sort of 2018, 2019, that this is absolutely a pre-pandemic issue, and it's due to a myriad of other factors, and some of which we've mentioned here. But what do you think what more can be done? Ozan, if you can start us off on this, what more can be done to kind of help the SMEs access that financing, do you think?
First of all, we have to value the importance of the SMEs in the supply chain. Without the SMEs, from upstream to downstream, these supply chains can be managed in a sustainable way with the presence of the, let's say, the big accounts or multinationals or whatever you call the commodity giants. Is it possible? In my opinion, it is impossible. It's not only about sourcing capacity or being capable of financing the transactions. There are also other roles which has been significantly played by the SMEs in the upstream and the downstream. Now, with the losing financing power of the SMEs, we see more and more multinationals acting like the financiers rather than the commodity players. Today, not only we are in the agribusiness, but not only in the agri, in all commodity chains, when you look at the presence of the multis, now the main value addition, the major role is coming through the financing power as of today. But from the point of operational power, from the point of value addition in the supply chain, it cannot be done with 5, 6, 10 multi-giant players. You need the presence of the SMEs. Now, how we can make them in the chain in a sustainable way, the SMEs, again, to give them the enough liquidity to maintain their power. Now, Tom underlined an important thing, which I want to, again, rephrase. Now, the KYC. Now, the bankers have called the KYC, in my opinion, in a very wrong way. Starting with the compliance studies, KYC, yes. Know your client, but know your client what they are doing. What is their role in the business? What is their business model? How their flows are happening? Because the moment when you control these flows, you really know your client, then the credit risks or the default risk or etc., they are all being mitigated naturally. The moment you lose the control on the real KYC of your client, I mean, just lend the money and expect it to be repaid after a time period and don't monitor how they use it, then the real problem is starting. That is why, in the past, the trade finance banks were, as Tom highlighted, were having the role of not only giving the money, but also monitoring and controlling how it has been used. The moment you have that control, then you have a proper financing flow. But the moment you lost the control, then you are ending up with the mess. And today, the role Tom is playing is just in the middle. He is doing the KYC, real KYC to the client, which was done by the banks in the past. But he is also fulfilling the expectation of the bankers' KYC with proper ratings, credit ratings, or etc. Either we will see more companies like TradeFlow participating in the chain to fill in this gap, or we will see the banks again increasing their appetite to come into the real business, real industry, and to finance these operations. That is, as of today, the dilemma we have in front of us. But frankly speaking, I'm optimistic. I believe that this is a temporary period, even though it has been taking 2-3 years' time. But at the end of the day, the fund needs to go to the real industries in somewhere. It needs to be on the commodities because this is just thousands of years of history of the humankind trading the commodities and exchanging the funds against it. I think after we see, this stormy weather cools down and we see a healthier environment, I personally feel that again, we will see more and more banks coming up again, as they have been doing it in the past. As of today, technology is helping them. Actually, if it has been properly used, it is helping them to monitor, to mitigate and reduce the risks. I think there will be a solution, long-term, stable solution will be found.
Thank you, Ozan. Thank you. Very, very enlightening. Tom, what are your views on this?
Yeah, so in terms of banks, they make money by lending, but as we've seen, they've had to been forced sometimes by regulation to actually leave the commodity industry. Many banks were in the past also traders and principals in the markets, as well as financing. A lot of that has gone, and so their knowledge of the market has also unfortunately been lacking. And a lot of the banks used to have physical trading operations, particularly the American banks. Not so much to make money, but just to also get information. Information flow on what was going on in the market, and hopefully that's something where companies like ours can help fill that gap and be sort of collateral managers with skin in the game, as we've been described by some customers in a way. And we are aligned with the lenders, with the banks and other trade finance funds to make sure things get paid for, or we recoup the investment somehow.
Yeah, absolutely. And I think I described you actually the last time we had a panel together as a CMA with skin in the game. So that's kind of gone full circle. I think both of you have mentioned regulation at some point as well, and I think it'd be remiss of us not to kind of talk about it in a little bit more detail. I mean, Ozan, perhaps you can talk just in general regulation, how that's possibly stifled the industry somewhat, and what's been the response to that, just in kind of general regulatory terms.
Regulation, I'm not an expert on it. I think Tom should be the right person to respond, but I can share with you our experience about the regulations. We have seen the main compliance issues starting from 2013-14 onwards, after some banks had been penalized. But we come to a period where no one knows what the real regulation is and what is being expected from the client, or what they expect from us to fulfill. Yeah, we know some sanctions, but behind the written rules and regulations, there has been silent regulations, which we have never been noticed on a written way, but always expected on a phone call that, don't touch here, don't touch there. I think that has been followed with the increasing KYC regulations, which is not being clear also. I think the same chaos is going on among the bankers, among the players, and maybe these were one of the reasons of the banks, to losing their appetite against the SMEs, because more clients means more paperwork. More paperwork means more, scrutiny, more labor requirement, and etc. That part, we don't know where it will end and what the real requirements are. That is what I can say. That was one of the major issues we have been experiencing in the last few years.
Yeah, thank you, Ozan. And yeah, I mean, I fully agree. And I think it's ramped up. I think there's been far more scrutiny in the last couple of years, really, after after some of the more unsavory aspects of what happened in the commodity finance space, turn of 2020. Tom, moving on to you with this. I mean, you actually mentioned earlier on a little bit about Basel III and the impacts of that. But as we're moving into Basel IV, what sort of impact do you think that's going to have on the banks, and how do you think that's going to enable them to view collaborative approaches, do you think?
Yeah. I mean, if I may just very, very quickly and add to what Ozan said, on the regulatory side, because there's regulation for KYC/AML. There's also good regulations around contracts like digitization. Can we accept digital electronic bills of lading or warehouse receipts or contracts, etc.? And the big traders initially are doing it, to help themselves save money and costs operationally. But we're starting to see countries all over the world adopting digital laws such that a digital copy is just as good as the paper copy, and that's obviously one of the few positive things, I guess we could say, has come out of this whole COVID-19 crisis, which has been a a horrible thing all over the world. Slipping into the Basel III situation, which has over the last few years, and the banks preparing for it, has actually really again raised the bar up in terms of what business they can do. When we looked at the problem that SMEs were having back in 2016, when we were formulating our business plan for what is now TradeNow, we could see that for many of the European banks that were the traditional trade finance providers, if a transaction is below $15 million, or a customer, did less than $200-300 million of turnover, it just didn't work for them. Now, we talk to some banks, it's like, well, if you've got $500 million turnover, then we can maybe talk to you, because the fact is the amount of capital they have to allocate against these types of trade finance deals just keeps going up and up and up and up. And also, a lot of the banks, unfortunately, under Basel, don't get any credit risk offset or mitigation by having the commodity on their balance sheet. So again, that's where this sort of the buffer comes in, where alternative lenders and companies like us can help be that neutral principle that's managing and looking after the asset that people are lending against. People are only just getting used to Basel III, and now Basel IV, a few years away. There again, it's sort of pushing banks away from using their own internal risk models in terms of internal rating models, and they get potentially penalized for using internal models. So unfortunately, that is sort of pushing things for the banks, pushing them into a harder and harder place to be able to, having to put more and more capital against all types of lending activities. In fact, the UK, there was some figure quoted, unfortunately I can't remember the reference, but where they said just British banks alone in London would have to raise £50 billion of extra capital just to meet Basel IV requirements. So, that's a good chunk of change.
No, yeah, quite right. I mean, I'm interested to see, we've been talking about this at our conferences for a couple of years now, and it's interesting to see what sort of impacts that might possibly have. But it certainly seems, from what you've said, and particularly that last statistic, anything that can reduce capital, the risk model or capital requirements, I think is going to be very, very, important. And I think your point on digitalisation as well is very important as well. And these platforms that can kind of collate documents, and in particular, how if documents can be seen, electronic documents can be seen in the same light as physical ones. And certainly, we've seen in your neck of the woods, Tom, the Electronic Transaction Act, which could potentially be a game changer, especially if it's rolled out globally, in terms of how digitized documents are viewed in the market. So I think that's another one to certainly keep an eye on, and we'll be talking about that later on today as well.
Well, that aside, I mean, digital documentation, digital law, that certainly helps improve the security around trade documentation as well, which is where we have had some fraud with the banks, over the last year and a half or so. So again, hopefully that will also help bring some of those banks back into the market.
Yeah, absolutely. Hopefully it does. So we've got a couple of minutes left. Is there a last word, Ozan, Tom, that you'd like to say based on what we've discussed in the session?
I'm done. I just as I tell you, we are still optimistic to see the developments upcoming. I am sure there will be a solution found. I don't know how it will be, but there will be a solution found, because this chain has to continue. From the financing perspective, I'm sure either the funds, alternative funders, or the individuals, there will be some solutions to be found out.
Absolutely. Tom, last word from you.
I'll just say that we hope not just for ourselves, but for all alternative lenders, in the trade finance space and ourselves in the trade enabling space, that banks will look to collaborate more and more with us. We think we don't compete with banks or lenders, and we only add value in making trades safer, and changing the risk profile on those transactions, and helping the banks and their customers get deals done, which is very important. As Ozan said, SMEs are very important. They bring 80% of the world's employment. They're always where innovation comes in as well. A lot of them are doing amazing stuff in ESG and SDG, and organic farming in the agri sectors, etc. So there's a very important and unfortunately underbanked sector group for most of the world at the moment.
Yeah, couldn't agree more. And I think it's we at TXF, it's a pleasure to shine a bit more of a spotlight on the industry itself. And it remains for me to say thank you very much to Ozan, thank you very much to Tom for joining me today to talk about a very, very important topic, as well as the collaborative finance solutions in general. Thank you both. Thank you also to the audience as well for watching at home, and for working with us on another virtual conference as well. Please, we're moving into a Q&A now. Please do, this is the last chance to get some questions to either Tom or to Ozan. Please do submit them. We'd be happy to get your views. And thank you again. Thank you.
Thank you.
Thank you.